Good morning, everyone, and thank you for joining us. Today's session is entitled the 2020 Year-End Tax Planning Seminar and Market Overview for Auto Dealerships. Today's session is being hosted by Counselor Buchanan and Mitchell, and our presenters today are John Comunale and Alex Seleznev. John Comunale is chairman of CBM's Automotive Industry Dealership Practice, overseeing a practice that has been active since the introduction of the Model T nearly 100 years ago. CBM's dealership practice provides expertise in accounting, auditing, tax, and operational issues to automotive dealers ranging from single stores to large dealership groups. John has more than 30 years in public accounting and is actively involved in auto dealership issues through the National Alliance of Auto Dealer Advisors and the Dealer CPA Network. CBM has 140 dealer clients with operations in 11 states. Many of these clients have 15 or more dealerships each. Alex Seleznev is a senior advisor and portfolio strategist at CBM and the firm's financial advisory subsidiary, MBI. He's a certified financial planner and a chartered financial analyst who leads the firm's investment management division. Alex's focus is on comprehensive financial planning and investment management. Alex is a regular co-presenter for CBM, including for the firm's market update sessions, which are held every other month. He is also scheduled to co-present with CBM Tax Practice Director Richard Morris tomorrow at 9 a.m. on year-end tax planning for businesses and individuals, and he's also going to be providing a market update there as well. You can register for tomorrow's complimentary session at www.cbmcpa.com. During today's session, please keep your video off as a courtesy to our presenters. If you do have questions throughout the session, please do enter them into the chat box, and our presenters will be responding to them over the course of an hour. They will be focusing on the content of their presentation just to make sure that they can get through all the material. And this session is also being recorded. Slides will be sent to everyone attending after the session. Thank you once more for joining us. I'm going to turn this over now to Alex.
Thank you. Thank you, Joe. And thank you, everyone, for joining us today. Perhaps for some of you who are less familiar with MBI, we're a subsidiary of CBM. We've been around for almost 8 years at this point, but many of our advisors have been doing this type of work for decades. So we're a comprehensive investment management and financial planning firm. Our core team has seven professionals. We have 5 certified financial planners, 2 chartered financial analysts, and of course, many CPAs as part of CBM. We're a fee-only and fully independent firm, which is important. Essentially, everything we do is done in-house by our team, so that eliminates many conflicts of interest. And essentially, we want to be your go-to team for anything financial. That is our objective. So with that, let's get started. We'll talk about the market conditions, make sure we update everyone on that. We'll talk about our outlook for 2021, and then we'll certainly cover some of our top strategies that we're thinking about at this point. So in terms of the S&P 500 index, and I'll be referring to it throughout this presentation, commonly used benchmarks for the US stock market, we started the year at a pretty healthy 3,200 points. And I'll tell you, perhaps by mid-February, I could tell you, I could come up with at least a dozen reasons of why almost 11-year bull market would end, but coronavirus was not one of those reasons. But then, of course, the virus happened, and in 11 calendar days, the markets in the US and, of course, around the world declined quite drastically, to say the least. The S&P was down as much as 31% by March 31st. But then the Fed stepped in. They lowered interest rates all the way to 0. The CARES Act passed. Many other things happened since then. And essentially, this so-called V-shaped recovery started. And at the time, I remember having these conversations in April, May, even in June. Anytime you would bring that up, the idea of a V-shaped recovery, people would think that it's pretty ridiculous notion. Since then, specifically as of last Friday, the S&P was almost at 3,700 points. We just hit that mark yesterday, actually, which gives us a pretty tremendous increase of 68% over the past 6.5 months or so. For the year, we're at positive 15% for the S&P. The Dow is positive 6%, and the NASDAQ, which is more of a technology index, is up this astonishing 39% for the year. Now, in terms of more recent updates, as of last Friday, 305 companies in the S&P 500 had positive returns for the year. Well, that is important for us because that tells us the rally we've been experiencing over the past month or so, it's been more of a broad rally. If you compare that to March of this year, when only 7 companies were in positive, or perhaps the beginning of the third quarter, when essentially the entire market returns were driven by 30 to 40 technology and consumer discretionary companies, that's been changing lately. In terms of the vaccine updates, we hear of them daily, sometimes even hourly at this point. There are 3, most promising of them at this point in the United States. There are a total of 9 developers around the world, and they're already testing it. And in the UK, actually, that's the latest update, and in other developing nations. So in terms of the US, perhaps we'll see something over the next few, maybe several weeks. In terms of our expectations, well, of course, it's hard to say, but who knows? Perhaps by next Thanksgiving, things will go back to some kind of normal. And that is actually one of the main reasons why we've been experiencing this so-called rotation from growth to value stocks over the past month or so. And essentially, one way of describing it, without getting too technical here, your growth stocks are so-called stay-at-home companies. Many of them would fit that category. And your value stocks are more of, going back to normal or going back to work type of stocks. So how quickly the vaccines would be distributed would have a pretty significant impact on that rotation. I'll talk about that more later. In terms of the sector performance, technology and consumer discretionary are still our leaders for the year. That's been the case for the past several months. And then energy and financial are on the bottom. That said, though, for both of those categories, energy and financials, they're up more than 15% over the past 30 to 40 days. Again, back to that rotation from growth to value. In terms of the US elections, it's become a little bit of old news at this point. So what you're looking at here, this is what we discussed in detail in our September webinar. We essentially developed 3 scenarios that were, the most likely ones from our perspective at the time, without necessarily focusing on the first 2. Scenario 3, when we have a Democratic president with a split Congress, is what we'll likely have at this point. At the time, from our perspective, at least, that was, the friendliest scenario for the markets. And again, I'm referring to the stock markets at this point. The idea of, continuation of existing favorable corporate tax policy and perhaps more predictable international, specifically trade policies, not necessarily more friendly, but certainly more predictable, would be better for the markets. Of course, we'll be paying a lot of attention to what's going to happen in Georgia on January 3rd, because that will likely have quite a bit of impact, again, on the split Congress situation. Now, I'll tell you, the markets certainly liked what happened on November 3rd. By November 6th, all 3 major indices were up 6 to 7% in 5 calendar days, which was actually the best return, post-election return since 1932. So people seem to really like it. The next chart that you're looking at here, this is a so-called asset allocation returns quilt, and it shows you the performance of each major asset class from 2010 all the way to year to date. And then on the very right, we have essentially the average for those categories. Large cap stocks are leading the way, almost 16% for the year. Domestic large cap stocks. Mid and small caps are up between 10 to 12% for the year. Now, that is good by itself, and especially if you look at it from the context of being down, 30 to 60% in March of this year for small caps. So that gives you quite a recovery. Emerging markets are up almost 10% for the year, and Chinese stocks are actually the best performing for the year. They're up more than 25%. Domestic fixed income or bonds are up 7%. A lot of those gains came from a drop in interest rates all the way to 0. Balanced portfolio, essentially a split of 60% stocks and 40% bonds, are up 5% for the year, which is what we normally target, 5 to 6% for those types of portfolios. Developed markets are up only 3%. They're still, struggling with the virus, just like we do in the US. Plus, they have many other structural issues. Cash is essentially flat. We're showing 0.44% at this point for the year. But if you try to keep your funds in cash, money markets or CDs at this point, you'll probably significantly less than that. Commodities as a group are in a negative 8% for the year, with the exclusion of gold and silver. Both of those commodities are up between 25 to 32%. We do think of them as fear assets, and then they tend to perform well in times of market volatility. And then finally, real estate is, as measured by the real estate investment trusts, is down 14%. A lot of other information that you can learn from this chart. A couple of things to point out. If you look at emerging markets and small caps, domestic small caps, how well they performed in 2012, 13, 16, 17, and then there were actually some of the worst performing asset classes in other years, specifically 2011. So that gives you this visual representation of the benefits of diversification to different asset classes. And specifically for those two, we do believe that if you decide to invest in them, they need more frequent rebalancing and perhaps more active management. They're not necessarily your buy and hold strategies. In terms of some of the key economic indicators, I'll start with the unemployment rates. Well, we were at a historic low of 3.5% in January and February of this year. And of course, coronavirus happened, and unemployment rates went all the way up to 14.7 in April. Since then, they've been gradually declining, currently at 6.7%, as the last figure was reported 5 to 6 days ago. Now, that's important. But perhaps what's even more important is what's in the actual report. How many people are no longer seeking employment, meaning they would be excluded from this figure? How many people regain their jobs, but not necessarily the same types of jobs? So we always focus on the percentage itself, but there's a lot of information in the actual report. Now, from the pure market perspective, full employment is considered to be when the unemployment rate is at 5%. So we don't necessarily need to go back to 3.5 for the current market rally to continue, at least from that perspective. In terms of the U.S. GDP, or gross domestic product, we're expecting a decline of 3.5%. That's a consensus. That's the average. The actual range is somewhere between -2 and -5. So we'll see what's going to happen by the end of this quarter. The vast majority, actually all of the analysts, are expecting 2021 to be a positive year from the GDP perspective, especially the second part of the year. The range is somewhere between 3.5 all the way to 7.2%. The average is 5.3. In terms of inflation, it's been essentially non-existent, at least as measured by the CPI, or the Consumer Price Index, 1.2%. So unless we have more economic activity, which is certainly a possibility in the second part of next year, we're expecting it to remain at more or less the same level for now. That said, though, that is something we're certainly paying attention to, especially for those of our clients who keep a lot of their funds in bonds, and would certainly be at a disadvantage if inflation picks up at some point in the future. Interest rates. This is on that we focused on this slide in our previous presentations in December 2019 and 2018. Not much to really say at this point. Interest rates are essentially at zero for most developed economies. They're higher for developing nations. In terms of the U.S., the Fed actually came out 2 months ago at this point and said that they're expecting to keep the same rates at least until 2023, meaning at zero. So perhaps things will change. Perhaps again we'll see more economic activity, but for now that is our assumption. This is actually a positive for those of you who mostly invest in stocks. Lower interest rates are usually a positive for equity investors, and of course it's a negative for fixed income investors and those who are trying to save, meaning they just keep their funds in their bank accounts. In terms of the market valuations, and here we'll look at the market valuations as measured by the PE ratio, or price to earnings ratio, which is one of the most common metrics. Essentially, the higher the ratio, the more richly valued something is. In terms of the domestic markets, we're at 35 at this point, which is of course significantly higher if you compare to the averages for the past 20, 30, and 90 years. So we're certainly at this elevated level. Perhaps not so much if you compare to the average for the past 10 years. If you compare to developed and international, international developed and international emerging markets, the U.S. is selling at the higher multiple. That said, though, that's been the case for the past several years. I in fact, cannot recall a year when the U.S. stocks as a group would be selling at a lower multiple. What is more interesting to us this year, in 2020, actually in the beginning of 2021, is the difference in PE ratios and other valuation metrics if you compare different sub-asset classes, specifically large growth and large value. So notice the valuation of large growth companies, technology, consumer discretionary, almost double if you compare to large value stocks such as banks, such as manufacturing companies. It's even more dramatic if you compare the PE for smaller companies, small value versus small growth. So when I talk about the sector rotation, well, this is one of the metrics that we were paying attention to. Now, in terms of our outlook for 2021, well, we are cautiously optimistic. And one of the reasons that's the case is, again, there are 9 major companies that are working on the vaccine at this point. Perhaps, something will be happening in the U.S. by the end of this year, but we're certainly expecting the rollout in the first quarter of next year. Perhaps there'll be more economic activity in the second part of the year. In terms of the stimulus package, there's been a lot of talk on that. Something perhaps similar to the CARES Act is not necessarily expected at this point. If you asked me a week ago, I would say, perhaps we're expecting it in the first quarter of next year. Yesterday, actually, I was reading the report. The latest iteration came from the White House, and they're proposing a $916 billion package that would include a liability shield for employers, another round of direct payments of at least $600 per person that was not in the previous version, and aid to state and local governments. So perhaps something will pass by the end of this year. If it doesn't, then more than 12 million people will lose their unemployment benefits the day after Christmas. It's not going to be necessarily a very pleasant gift for them. In terms of the monetary policy, we expect it to remain accommodative, essentially what the Fed is going to do over the next 6 to 9 months. Essentially, the rates will likely remain low, and they'll continue to pump money into the economy. Now, at the same time, we do expect the volatility to continue for the reasons that I just mentioned, for exactly the same reasons I just mentioned. The markets are always forward-looking. They're always discounting for what they believe will happen over the next 6 to 9 months. So if the updates over the next 3 to 6 months are not as good as expected, well, chances are we'll have more volatility, especially if we look at the current valuations. So we absolutely want to be prepared for that. Rotation from growth to value. We do expect that to continue happening throughout next year. How quickly? We'll wait and see. And I'm certainly not saying that technology and consumer discretionary stocks are bad. All I'm saying that is at some point people will be looking at those valuations and perhaps taking some gains off the table to reinvest in something more reasonably valued. In terms of fixed income and bonds, well, we expect the yields to stay low, actually for a while, not just in 2021. And also we expect total returns to stay low. And yields and returns are not necessarily the same thing for bonds, because in the years such as 2020, even earlier this year, we had low yields, but when interest rates went down all the way to zero, that actually resulted in higher prices of bonds. But at this point, it's nowhere to go, essentially. So we have to be careful. In terms of our strategies, well, we continue to believe that that diversification remains your key to success. 2020 is essentially the best example I can come up with at this point. Now, first 2 quarters of the year, bonds and large caps performed quite nicely compared to other asset classes. Emerging markets performed really well in the second and third quarters, and now we're getting closer to the end of the fourth quarter. Mid and small cap stocks are our leaders. If if your portfolio is invested in stocks or other types of equities, and especially if you notice that some of those asset classes bubbled up a little bit, perhaps this is a good gains off the table and rebalance into different asset classes, or simply rebuild your reserves if you're expecting more volatility next year. For those of you who are heavy in bonds, well, we suggest that you revisit your allocation, especially if you're expecting higher rates of return. Perhaps you should lower your expectations. Focus on higher quality and shorter maturities, because there's simply not much of a benefit of taking more risks and extending, duration of your bond funds. And of course, consider alternative options depending on your risk tolerance and your overall plan. Consider stocks that are paying dividends and have a history of increasing those dividend payments, again, to replace some of the lost income and also position you for potential inflation. Consider preferred stock. Those types of securities tend to pay at 5 to 6%. They have higher yields, not as safe as bonds, but certainly not as aggressive as stocks. And finally, if you need to maintain your portfolio in bonds, consider multi-sector bond funds and total return strategies. Again, more aggressive, but have higher yields. And in terms of the total return strategies, they can actually sell their underlying holdings inside of the fund and generate some capital gains. For those of you who are more aggressive, more growth oriented, consider revisiting your allocation to emerging markets, specifically Asian economies. They seem to be recovering better compared to developed nations from the virus. Plus, of course, with what I was saying earlier about the U.S. trade policy, perhaps it's going to become more stable. That would likely be a positive for those parts of the world. And finally, if you do believe that there's going to be a recovery and you want to benefit from that, well, consider moving a portion of your portfolio into more economically sensitive companies, specifically mid and small cap stocks. They tend to be the first ones to go down, just like they did in March, but they're also the first ones to recover. So that's where perhaps most of the gains would come from. So with that, I'll ask John to share some of our tax strategies with you.
Good morning, everyone, and thanks for joining us this early on Wednesday morning. We'll start with just some year-end tax planning that would affect you individually, and then get into some business tax a little later. So it wasn't really a lot of changes from 19 to 20. I mean, 2019 was a huge change in the tax law, one of the biggest in I think 3 decades. So year-end tax planning strategy, charitable giving, donor-advised funds, where you could front load your donation in 2020 if you were planning on maybe giving to a charity over the next 3, 4, 5 years. You could donate the full amount in 2020 and take advantage of the current tax law. And then the charity could distribute those funds over a period of whatever you agree to. Next point, loss harvesting, taxable accounts. If you have, if you have a lot of capital gains and then you have some loss positions, you might want to take advantage of that. Be aware of your estimated tax payments, your 2019 impact on 2020, depending on your income level. 2020 would be based on 19. You could under the safe harbor rule. Bunching donations, as I discussed earlier. And whatever you do, make sure you have it documented, just in case. So gain and loss harvesting, your capital losses are limited to $3,000 a year, and unless you have capital gains. So you have to be careful there. And those individually would never expire, so you could carry them forward indefinitely until they're used. If no capital gains to use them against you, are capped at $3,000 a year. There are the preferential tax rates currently on long-term capital gains, which are in the chart to the right. So mainly, 15% if your income's under the levels listed there, and up to 20% if your income is over. And if it's a non-business asset, it also adds the 3.8% Obamacare tax, most likely 23.8 on stocks you hold as an investment. So it depends, I guess, on your tax situation as to what you want to do in this area. A low income year, you might want to take advantage of it and add the capital gains to your taxes. A high income year, it all depends on what you have in the way of losses or capital gains. And it depends on market conditions, as I'm sure Alex would agree to. And you could even, if you sell, you could sell a stock and rebuy it. I think you have a month. You have to wait a month to rebuy it. But you could sell a stock, either take advantage of the gain against your losses, or if it's at a loss, you could take advantage of the loss to offset capital gains you might already have for 2020. So other strategies, too much tax paid in versus not enough. I know a lot of people that I deal with would rather not have the government hold their money and try to, cut that as close as possible. So in most cases, your safe harbor is 110% of last year's tax if your AGI is greater than 150,000. We used to do a lot of calculations at the end of the year to make sure you took advantage of your state income tax deduction, but the state and local tax limitation, where you're capped at 10,000 and your itemized deductions, really has eliminated all that. And right now, you're usually just follow the safe harbor rule and pay them by January 15th of next year for the fourth quarter of 2020. Review your carryovers and applications. If you have passive loss carry forwards, capital losses, you might want to take advantage of them by, as I mentioned earlier, selling some of your gain stocks to offset it. And you may consider generating the taxable income just to take advantage of it. So your timing of deductions and strategies. Currently, there's no real limitation on your itemized deductions, so that you might want to take advantage in 2020 of that. Of course, we don't know what's going to happen to the law going forward. Review your retirement contributions. For 2020, 19,500 is your max on a 401k. And if you're over 55, you could add another 6,500. So that's 26,000. And 2021 is right now is unchanged. There you could also take advantage of your IRA and 401k conversion or rollovers. Depending on your tax situation, you might want to convert that to a Roth IRA and going forward. Take advantage of the current tax law, where the rates are currently lower and anticipated to go up in the future. So how did we get here? As I mentioned earlier, we're heading into, well, actually, no, this is year 3, 2020, of the most significant tax change since 1986. With the new administration coming in, there is going to be a change, but we're not sure what year. So the tax reform from 2018 is going to totally be changed, we believe. Then we had, of course, we had coronavirus aid relief and the Economic Security Act of 2020, the CARES Act, which of course is the PPP loans, and then the Secure Act is there also. So, and that has, so the Secure Act is just a lot of changes to retirement accounts going forward. Individual tax, the standard deduction is now 24/8 filing joint for 2020. And that, I think, eliminates a lot of people from itemizing, because it was a big increase from where it was prior to the tax change in 2018. Personal exemptions are eliminated for federal. A big item is the federal estate gift exemption. Right now, per individual is 11.58 million for 2020. So for a married couple, you have 23 million of exemption, state exemption, gift exemption. So you could theoretically give 23 million in 2020 of your estate to get it out of your estate and not be taxed on it. We're anticipating that's going to change. So that is something to keep in mind. There was no changes to Maryland or Virginia in the estate law. Maryland, I believe, is 6 million. Virginia does not have an estate tax. DC is going to decrease to a 4 million exemption effective January of next year. Still 7 tax brackets, lowest being 10. Currently, the highest tax bracket is 37%. AMT is still there, but it affects much fewer taxpayers than it did prior to 2018. And as capital gain, their tax rates we went over earlier. The qualified dividends, 15%, depending on your tax bracket, but most people are probably at 20% plus the 3.8 Obamacare tax. And there's just a snapshot of 2020 tax brackets for your taxes due right now, April 15, 2021. I know last year we had an extension to July 15th, but I don't really see that happening this year. Individual deduction changes. The standard deduction is much higher. So if your home's almost paid off, your interest deduction is probably not enough to get you up to itemizing. So some categories, though, we commonly deduct have changed. The charitable deductions is increased to 60% of AGI, and deductions of appreciated stock is still at 30% of AGI. The $300 above the line cash contribution deduction is allowed. 100% of AGI limitation for cash contributions. So 2020 could be a good year to front load those cash contributions, because there is no limitation on your Schedule A as there was prior to the new tax law. And the SALT limitation, your combined state local property taxes is still 10,000, and we'll get into the Maryland SALT workaround a little later in this presentation. Some items that were commonly deducted have changed. The mortgage interest post 2017 debt limited to 750,000. If the debt was in existence prior to that, you're grandfathered in, so it's $1 million plus 100,000 of a home equity, as long as it was used for home improvements. So it's 1.1 million is the grandfathered in amount, and any mortgages incurred after 2018 is 750,000. Effective January of 2019, you can no longer deduct alimony. The Secure Act was passed December 2019. 2015, it moved your required minimum distributions up to 72. It removed your age-based limitation on an IRA contribution, so that no longer is in effect. And the stretch IRA for accounts inherited by a spouse is removed, so you can no longer stretch that out forever as you were used to. Also allows the 529 accounts to be used for student loan repayments. Qualified charitable distribution is a direct transfer of IRA funds to a qualified public charity. It was the temporary. The PATH Act of 2015 makes it permanent and counted towards satisfying required minimum distributions, starting at 72 up to 100,000 per individual or per spouse. And it excludes the required minimum distribution from taxable income if it is a qualified charitable distribution. Generally, most, it's good to do it later in the year just to see where you stand. It's easy to complete, but you need to do it if you are planning to transfer our funds to a public charity. You need to do it before the end of this year. Okay, business tax. C Corps, the flat rate was reduced for most C Corps from 34% to 21%, starting in 2018 with the new tax law. But keep in mind, on a C Corp, when you draw that money out, it is a dividend subject to another 20% tax. So in effect, that rate is still higher than the pass-through entity tax rates, where the top rate is 37%. But most of our dealership clients, the pass-through tax rate is, I believe, 29.6% for federal, and that is taking advantage of the QBI deduction, a little later in this presentation. Section 199A is the 20% deduction. So that 20% of your ordinary income on your K-1 is you're allowed to deduct on your personal return, and it's capped. It's based on your wages paid in the business, and in most dealerships, those wages are high enough where you get to take full advantage of the 20% QBI deduction. And it's available to partners, LLC members, S Corp shareholders, sole proprietors. The business tax, there is relief to non-corporate taxpayers, which I just listed, partners and shareholders. In a single member LLC, which some of our dealerships are, they don't file a return. It's a disregarded entity. So that is reported on a Schedule C of the individual taxpayer. And in some cases, it is the full dealership return is all reported at the 1040 level on Schedule C. So in that case, that individual is still able to take advantage of the qualified business income deduction. So if their ordinary income on that business is $1 million under Schedule C, they'll most likely get a $200,000 deduction against that income. It can't exceed 50% of wages paid, or there is a complex formula of wages and depreciable assets. In most cases, you'll hit it, easily hit it with the wages paid. In some cases, maybe on your real estate company, it is based on depreciable assets. Personal service corps, they do not qualify, and there are exceptions for very small businesses. There's a part of the new tax law limitation on business interest deduction. The general rule, the deduction is limited to 50% of adjusted taxable income. It was 30% through 2018, and then in 2019 it was made 50% after COVID. So I don't. In most cases, with this increase to 50%, I don't see there being a limitation of your interest deduction. If your dealership is under 25 million in revenue, which is unlikely over the 3-year prior average, then the limit does not apply. Your adjusted taxable income is taxable income plus or minus interest expense, and you also add back your depreciation to that also. And the exception, small business under 25 million average gross receipts do not have to prepare, I believe it's Form 8990 for computing whether or not you have any interest limitation. Cost recovery, depreciation. There are some changes. This year, there was a correction made to qualified improvement property prior to the new tax law. QIP was 15-year, and then there was an omission that was corrected just last year in 2019, and that is where your qualified improvement property for a dealership is mainly your factory refresh or updates, and related to your showroom and service lane. It has to be an improvement that is frequented by customers in a retail establishment. It also cannot be any structural improvement, and it cannot increase the square footage of that area. So most showroom refreshes would qualify for it, and includes it, and also including the service lane renovations. I mean, that they all qualify for treatment of the 15-year property. So also the auto depreciation limits were greatly increased, and that is luxury automobiles. So bonus depreciation currently is 100% through 2022, and that applies to your qualified improvement property. So if you spend $1 million to refresh your showroom, and it falls into the 3 categories I mentioned earlier, you could expense that $1 million in the year it was put in service. So right now, that would be 100% in 2022. Or I'm sorry, 2020, 2021, 2022. So starting in 2023, it phases out, I believe, from 80% down to 0 in 2026. So if you are required to, if you have a requirement to make improvements, the manufacturer's pressuring you for that, and you know you have to get it done, you could take advantage of the full expensing, as I mentioned earlier, as long as you have that in place and in service before the end of 2022. So luxury cars, that's the increased, in year 1, you could expense $18,000 of a luxury vehicle. And in most cases, I mean, that would be a company vehicle, not a parts truck. Those are not, they don't follow into that. It would just be maybe an owner or manager's using that car for business. You're capped at 18.1, and then goes through year 2, 3, and 4, and thereafter. You also could take advantage of the Section 179 deduction. That for 2020 is 1.04 million, phased out if you have more than 2.6 million in additions. So 179 could be advantageous if you're in Virginia, because Virginia follows Section 179 for federal, so you would you can take that full 1 million in expensing. but you cannot, bonus depreciation you could take and throw you into a loss. Section 179, they're capped at the amount of income from that entity. And also keep in mind, although there's no cap per individual on this, it is capped at the individual level on your personal return. So you would be limited at to 1.04 million in Section 179 at a personal level. So some tax planning is required for that. Virginia follows federal, not for bonus, but for 179. Maryland does not follow federal for bonus or 179. So in your first year you have a big federal deduction in Maryland, but then most of it would get added back to income in Maryland. But then going forward, you would get the deduction for your state taxes that you wouldn't have for federal in future years. So, COVID items, business tax. The QIP was changed from 39 to 15, as I went over earlier. By having a 15-year life, you are eligible for bonus depreciation. That was the correction. For bonus, it has to be under a 20-year life. So at 39-year life, you couldn't bonus it. You were stuck with the 39 years. Another COVID item is your FICA taxes, I guess for cash flow purposes, could be deferred throughout the year, and 50% of those taxes are due at the end of 2021, and the other 50 at the end of 2022. Employer payroll tax credits, that is the per employee if they're not COVID related. You for 2 weeks if you pay them for those 2 weeks, you get a credit against your payroll taxes going forward. If you do take advantage of that credit, it reduces your PPP loan forgiveness, which that application period has opened, and it's I think most of you either have them ready to go, maybe some have already submitted them, but it is due 10 months after the deferral period ends. So I understand once you submit to the bank, they have 2 months for approval. Once they submit to SBA, there's another 3 months the SBA has to approve that forgiveness application. I do have some clients that have already submitted, and in that case, their bank, if your payroll expense is enough for full forgiveness, the bank wanted to let us know that you don't need to do anything else. It just holds up the process if you add everything else to it. So if your payroll is more than enough, which I think it probably is in most cases, then that's all you need to submit for these forgiveness applications. A big item that everyone's waiting on is the PPP loans were meant to be tax-free. Your forgiveness is tax-free, but really it's not, because the expenses you used, if you have $1 million PPP loan and used 1,000 and you used that $1 million, those expenses have to be added back to your taxable income in 2022, or I'm sorry, 2020. So it really isn't tax-free. You figure 40% of that is going to be taxed. Now, it wasn't the intent of Congress for this to be a taxable loan, but they're stuck with the IRS code that has been in place for decades, where the forgiveness of debt, expenses used for debt forgiveness are taxable, and that is the code. I believe that's been waived in one instance in the past, and there is a bill from Congress trying to get this waived for the PPP loans going forward. And everything I read, there is all 50 states, every CPA association in the country is lobbying Congress. The NADA is lobbying them, and I'm sure every industry's association is lobbying Congress to get this passed. So, but for now, we have to follow the law, and it's taxable until we hear differently. The new administration tax proposals under Biden, top rate goes from 37 to 39.6. If your AGI is over 400,000. Capital gains, 39.6 if your AGI is over $1 million. So for a lot of people, that 20% is eliminated. Now this is the proposal. Child tax credit from 3,000 to 3,600 per child, fully refundable, and restoring the itemized deduction limitation if your income's over 400,000, whereas you're dependent on your income level, your itemized deductions are limited, and the higher your income is, the greater the limitation. And prior to the new tax law, I mean, that limitation was pretty substantial on high income taxpayers. And it also would cap itemized deductions at 28% of your AGI. One thing it is proposing is to end the state and local tax $10,000 cap rate. Currently, that SALT limitation in Maryland is allowing businesses, pass-through businesses, to pay that tax with their return and get a deduction on page 1 of the return. So you would get you would be able to deduct that tax. That's a workaround to the $10,000 cap. So you could deduct that tax at the federal level, and therefore you eliminate that 10,000 cap. Now, from a lot of things I've been reading, if it goes to appeals at the federal level, it probably won't pass. But right now, it is available, and I guess more to come on that. So cash flow, even though you might have paid estimated payments into Maryland already, you could take advantage of this, and you would just have to apply for a refund of those when you file your return, or those estimated payments. So that's probably another whole presentation going forward. There's a lot to it. So individuals, this is also Biden proposal. The loans are canceled tax-free if you're enrolled in a repayment plan after 20 years, and also it's going to eliminate the step-up in basis at death. That's his proposal, which is huge. The corporate rate for C Corps goes under Biden from 21 to 28%. And I believe this is for mainly publicly traded companies, where you have a minimum 15% tax on your book income in excess of 100 million. I think that that mainly is for big public companies. It would end the QBI for real estate investors and anyone earning greater than 400,000. So that pretty much that 20% deduction against your pass-through income from the dealership would be gone under the Biden proposal. And the minimum GI/LTI rate is increased to 21%.
All right. This is what we have for us today. And if you have any questions, please, we have a a few more minutes for any questions. Please type them in the chat box and we'll try to address them. And we also have many other events coming up. January 19th, February 9th, and February 23rd. We'll mostly be talking about different financial planning strategies such as Social Security, how to choose a financial advisor, and for those of you perhaps in your late 50s, early 60s, perhaps you would be interested in our medical presentation.
If anyone has any questions on what we went over, please email either Alex or myself. And once again, thanks for spending an hour with us this Wednesday morning, and have a great day.
Thank you, everyone.